Good afternoon from the Shreveport office of Eagle Financial. Happy Friday to everybody. It's another edition of the Jack and Bill Show today. Markets have been all over the place since the new year began. We closed down today coming into the long weekend. The markets will be closed on Monday for Martin Luther King Jr. Day. So the S&P 500 was down about 0.7% today. All of the major indices closing down. That leaves us year to date on a total return basis up somewhere around 0.4% to 0.5%. Most of the market indices right in that range. Yes, S&P was down 27 points today, or call it 72 basis points, or 0.72%. Gold was down $25 to $18.26 an ounce. For all you Bitcoin followers out there, that was down about 7% today, or over $3,000. West Texas Intermediate closed down $1.39. This black gold has been strong in recent months, closing at 52.18, but down
Intermediate closed down
over 2% today. The NASDAQ market breaking below 13,000 to 12,998, down almost 1%. The Russell Russell 2000 small cap index down a little bit more, about 1.5%. This is coming on the wake of President-elect Joe Biden announcing nearly a $2 trillion stimulus package, about 1.9. That's a huge amount of fiscal stimulus that a lot of people feel is necessary for the economy to gain traction. Haven't really looked into the bill, but this would ordinarily be terrific news. The markets should have gone up today, but I think oftentimes with the stock market, very hard to predict on a short-term basis. Oftentimes you get selling on the good news and buying on the bad news. We may have had some of that today, but also, Bill, concerns that how are we going to pay for all this? This $2 trillion being added to the national debt. Safe havens in the bond market has started off the year really in terrible shape, with yields, longer-term yields escalating. The 2-year Treasury note closed to yield 0.14%. Not much changing there because that's really tied to the actions of our Federal Reserve, Jerome Powell and all those cronies, keeping the Fed funds pegged at zero until 2024. But on the long end, we're getting some concerns there, some selling pressure. The 10-year Treasury note, while strong today, it's gone from the lows of around 0.5% to closing today at almost 1.1%, and the 30-year Treasury bond yield showing strength today, but closing to yield 1.85%. So getting very close to 2%. And we're not going to get into that. But we're ready to get into the meat of what we want to talk about. I want to welcome Bill, back in the saddle today. So we have, Bill pretty much wrote this whole thing. I'll give him credit for that. Our first newsletter to start off the new year. And Bill, why don't you jump into this thing and tell our viewers what we want to talk about?
Well, one of the things we want to do is we do want to cover some of the major themes that we talk about in our newsletter. Look, there's a lot of forecasts that come out this time of year, and we don't want to be counted amongst those who are making predictions about where the markets will end at the end of 2021. That's just an exercise that we don't even bother with. because in reality, no one knows, how the markets will end. And just look at last year. I mean, who would have anticipated that we would have had the year we had last year? And that's how we open in our market outlook is, lamenting poor 2020. Remember how excited everyone was when we began 2020, and everyone was hopeful, and there were lots of optimistic things being said publicly, and then we get hit with this global pandemic. We have a huge sell-off in equity markets and risk markets in general, and then lo and behold, we end the year with the markets performing extraordinarily well. Who would have thunk it?
Yeah, that's S&P 500 closed up about 18% last year. The Dow was in single digits, but the NASDAQ market was up more than that. And S&P 500 there's more money in America anyway, benchmarked to those 500 large cap companies. So that's really the best definition for what the market did last year. It's a market capitalization weighted index, but basically the best way to quantify that to me is in a normal year, the stock market goes up 9 or 10%, or we've averaged about that since 1926. And so we got 2 times the normal return last year.
And notably, those positive returns came in the last 2 months of the year. So the markets or the S&P 500 was basically break even until we got into November. And then we generate the positive year-to-date returns in the last 2 months. So it was a remarkable year. I think everyone is just so relieved that 2020 is over, and people are looking forward to some kind of improvement in this current year, be it unemployment, the reopening of the economy, what have you. But we may see more volatility going forward. And that is one of the themes that we discuss in our outlook. It does seem like markets have been complacent, in spite of the volatility that we experienced in March and April of last year during the depths of the pandemic. But there are things that do lull people into complacency. And one of the biggest things has been all of the stimulus that we've seen being pumped into the markets. The global central banks, have done a yeoman's job of keeping things going, pumping liquidity into the system. And now we've also seen fiscal stimulus. And it's rare to see fiscal and monetary policy stimulus measures working in concert like this, not just in the U.S. domestically, but globally. And so, when we see the news about, the incoming administration and their proposals to pump even more fiscal stimulus, that gets people excited. And that could support this market rally and keep it going for longer.
Yeah, I think that the consensus among economists for economic growth for 2021 with this $2 trillion nearly fiscal stimulus package is has us at around between 4 and 5%. I mean, the developed world has been mired in this economic growth that's been something like 1.5 to 2-ish for a long time.
That's right.
And we've had a crowding out effect from the debt that we've had. And really our central bankers, the world central bankers, Japan, European, and U.S. most notably, can't do a whole lot more with rates already at 0 or 18 trillion outside of the U.S. in treasury debt that is negatively yielding. So we think we're going to have. It looks like we're going to have economic growth, maybe in the 4 to 5% range. I think Europe looking not as good as the U.S. right now. So if we get that, here's the way I look at it, Bill. If you look at the earnings of the Nasdaq market and the S&P 500, we're selling at a PE of 40, a
Yeah,
PE of 40. So you're paying $40 per share for every dollar per share in earnings, where the historical PE ratio is 17.2.
mm-hmm.
So we could actually have very strong economic growth this year, very strong corporate profits, and see the market just go sideways because the earnings need to catch up
That's right.
to bring the PE back in line, historically speaking.
Well,
Yeah,
that's right. And when markets are rallying, that's a time when people are not paying attention to valuations. It's just too easy to ride the momentum wave and, throw caution to the wind. Who cares, what Tesla's valuation is? Who cares, what the NASDAQ's PE ratio is compared to historical? Because it's just going up, up, up. And that's what we saw happen last year. When we talk about the index performance and especially the S&P 500, and it's important because the S&P 500 is the US benchmark. It is representative of the US stock market, but its composition is not. And we see huge concentration right now in the S&P 500 with big tech companies. I mean, right now, and we wrote about this in our outlook, you take the big tech companies, the big five, Apple, Microsoft, Amazon, Facebook, and Alphabet, they're comprising about 22% of the S&P 500. That's huge. Long gone are the days when companies like, Berkshire Hathaway, GE, GM, IBM, companies like
Exxon,
the Exxon,
Exxon
were in the
Mobil
top
kicked out of
five.
the Dow this year.
I mean, those days are gone. Now the biggest constituents are all in one industry, technology. And so that has juiced returns, for the market index. Now, if you jump to the NASDAQ 100, the concentration is even worse. Those same top five companies comprise 46% of the NASDAQ 100. But because we've seen the performance in the index concentrated in these names, we've seen their representation balloon out. So these same five names, their composition in the S&P 500 increased by 9 percentage points in less than 1 year. And we also looked at, in terms of what worked last year, it really was a bifurcated market. It was either the haves or the have-nots and very little in between. And so for the haves, those stocks that really did well, obviously the big tech companies, but we'd also lump in there the stay-at-home technology companies. Okay, these are the firms that benefited from the lockdowns. You think about, like people working from home and the technologies that they had to utilize to work from home, or people who are, getting, products delivered to their house, those types of things. Those names did exceptionally well, but they also brought forward, a lot of future demand for their products. So we'll see how they do going forward. But the other half was Tesla, and isn't it interesting that the S&P 500, which is so concentrated in big tech, just recently added Tesla to the index? So that only exacerbates this performance concentration issue. But you strip those out, and the market really didn't do a whole lot last year. So we're contrarian to a large degree, and we see the value in looking at things that have been overlooked by the majority. And so we say that the things that worked last year may not work this year. And there's a lot of things out there that are cheap on a valuation basis. And that's one of the things that we would, advise people to do is take some money off the table in those things that did the best last year and start building positions in those things that lagged, old economy, value, cyclicals, and the like, because those could be your winners going forward.
Yes, I agree, William. So, one area that's done very poorly compared to the domestic markets for a season is international.
Mm-hmm. Yes.
So we like international. We like value
Mm-hmm.
international. We like value both. We like it domestically as well. Things like Berkshire Hathaway, insurance companies, banks.
Mm-hmm.
Then you mentioned cyclicals,
Right.
autos, those things. Really,
Energy.
we've seen some of these really picking up steam lately,
Yes.
like Ford. Okay, Ford Motor really strong in the last few weeks, and I'd rather own Ford right now than Tesla.
Yeah, me
What?
too.
Yeah, I mean, it seems like there's these Robin Hooders that would like Ford. Why would I own Ford when I can own Tesla? But
We know it's not exciting, but the thing about investing is, it's not about putting money into that which is the sexiest, the most glamorous, the most exciting. It's about making good returns on your money. And one of the things that you have control of as an investor is how much you pay for something. So Tesla, no, we did not invest in Tesla. And for those who did, congratulations. Similarly, we did not invest in Bitcoin. For those of you who did, congratulations.
but speaking of that, we continue to like commodities.
Mhm.
This is a theme that we want to discuss today. The silver appreciated 47% last year. That's not a bad return
Not at all.
on your
Not
money.
at all.
And gold was up not quite as much, a little more than half that. And both of those metals are down year to date. And I see that turning around.
Mhm.
I see the performance of precious metals continuing. What they did a year ago. They will be volatile along the way, but that's one of the themes that we're seeing here is one of the things that I believe is that the actions of the world central banks is going to bring about a secular time, long term. You can think seasonal, short term,
Mhm.
cyclical, the business cycle, secular, very long term. Like interest rate cycles can be 50 years or more
Well,
in duration.
U.S. interest rates peaked in the early 1980s and have been steadily declining ever since.
So that's 40 years.
Yes.
Yeah. So this is what I think is we're starting to see long-term interest rates heading up, or you could quantify that by using the term steepness or the
Mhm.
steepness, like the 10-year Treasury note yield minus the 2-year Treasury note yield. That differential has been climbing.
Mhm.
That's worrisome, really, for conventional asset classes like stocks and bonds.
All right.
So
Well,
we
let me just ask you to explain. Explain to our audience why a rise in interest rates is harmful to bond investors as well as stock investors.
Well, if you start with the with the dollar or our currency or our treasuries, first off, by definition, just the way the bond math works is that if interest rates go up, there's an inverse relationship there, and bond prices fall. So a bond is very much like a stock too, without the moving parts. But another reason is corporations are levered,
Mhm.
and so if they borrow money, they're going to be borrowing money at higher interest rates, and everything starts with the treasury curve and
Mhm.
trades off of that.
And that affects their bottom line because they have higher
That's
interest expense.
exactly that's exactly right. But one of the worrisome things too is that we've seen the bond markets, I think, sell off in anticipation of an abuse of too much fiscal
Hmm.
stimulus. Which I don't know how we can really justify this. And imagine what the interest costs are going to be to governments around the world,
Mm.
or even municipalities, state and local government. So this, we talked about a crowding out effect of economic growth because of just this choking out feeling from the interest on the debt.
Well, and
And
that's something we've looked at in the past. We've looked at our fiscal budget, uh, U.S. budget, and when you itemize and you break it out, between entitlement spending and military and other programs like that, and then you have the interest expense on the national debt outstanding, there really is very little left for discretionary spending. And isn't it strange that as our national debt keeps going higher and higher, that the interest rates that we pay on the debt keeps going lower and lower and lower? Now, if that were me, that wouldn't happen, because if I were to go to a bank and show them my personal balance sheet and my debt keeps going up, 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 well, the lender will keep charging me higher and higher rates of interest to compensate for that credit risk. But globally, we're seeing governments able to borrow and ramp up their borrowing at ever lower and lower rates. And so that is a problem, as you say, Jack, because when we do see interest rates begin to normalize, the debt and the corresponding debt service on that debt will completely crowd out discretionary spending. And what will the governments do then? I guess, raise taxes if they can. But that's why, we are hearing, some rumors about interest controls. I think everyone around the world has gotten really comfortable with their ability to borrow at these historically and artificially low rates, even negative rates.
there's a day coming, Bill, that markets will determine the prices of bonds
Eventually.
and assets, stock prices, instead of or rather than governments and central bankers. And
But like,
this pandemic has really hastened that occurrence that's coming down the road. We don't know when.
well, that's right. But getting back to, the risk to, bonds and stocks, and I want you to elaborate on the risk to stocks and stock investors, but for bond investors, with interest rates this low, and we have seen price appreciation in the bond markets as interest rates continue to trend lower. But now we're starting to see risk to the upside with interest rates. And so with rates these low, yields these low, there's just no cushion left. So as we see rates move higher, your interest return on your bonds can easily be wiped out. So if you're a traditional bond investor, you really need to take a look at your bond holdings and evaluate interest rate risk, because you may be taking on a lot more risk than you realize going forward.
I think a lot of people, elderly people that live on a fixed income, have felt trapped into
Sure.
moving out on the yield curve. One of two things, Bill: going longer duration on their bond holdings, or decreasing credit quality. And those are two things that I would not recommend. I mean, in just about all cases. Okay, so when if people that live on a fixed income who have owned long dated treasuries in the last 3 months have seen their bond portfolios really take a hit, and it's likely, in my opinion, for that to continue.
Mm-hmm.
So, and then
the risk to stocks.
Yes, I mean, then the risk to stocks. I mean, if you think about it, any asset is worth its expected future cash flows discounted back to the present at the cost of capital. So the cost of capital, if you think of a bond that really doesn't have moving parts, if interest rates go down, that's in the denominator, the price goes up. Same thing with the stock market, the cost of capital. The cost of capital being the cost of retained earnings, the cost of debt, the cost of preferred stock, the cost of common stock. If that's in the denominator, if that gets bigger, the value of the investment is going to decline.
Mm-hmm.
So that's what I think that we're
And which
entering into.
which broad category of stocks have benefited the most from these artificially low discount rates in the calculation of their present value?
Well, I'm not sure what it'd be the NASDAQ
Yes.
names. It'd be the ones that growth stocks that don't pay dividends. Because of the actions of the world central banks, you could call these long duration assets. That means interest rate sensitive,
Mm-hmm.
long duration. So that's like a 30-year treasury bond today has a duration of something like 23, just off the top of my head. That means if interest rates go up 1%, it declines 23% in value. So that's something that can very easily occur
Sure.
over the next 12 months. And so these long duration, think of NASDAQ stocks, for example, or Tesla as a long duration asset. It could easily lose half of its value with higher interest rates.
And one of the things that influences interest rate movement is inflation or inflation expectations. We don't have to actually see the inflation manifest right away to have that impact. It could just be the expectation of it, or the expectation of the Fed tightening monetary policy and letting interest rates move higher. But there is a strong connection between the two. And we have been very fortunate to have low inflation. But again, the other side of that is that we've been kind of borderline disinflation, deflation because of recessions that we've had, going back 10 years plus. But at some point, we will see inflation come back, and there are a number of reasons why that can occur. But inflation is a very bad thing for bond investors. And while stocks can hedge some of that to a degree, if we see meaningfully higher inflation and inflation expectations, there has to be somewhere else for investors to go.
And William, that's interesting. I'm looking at a text message that I got from a friend of ours that works at a hedge fund. You could call it that. Or they run a 40 Act fund, which we own, and half of the fund engages in trend following in the commodities markets. Mm-hmm. And these are the trends that are really kind of pronounced right now. The dollar has been, yes, the dollar has been declining against the euro. Energy prices have been escalating. Mm-hmm. All the crudes, Brent, West Texas Intermediate, not today, but in the last few months, shorting long-term bonds because interest rates have been escalating. And then agricultural commodities. Here you go. Here's how, going with what you're saying, Bill, we could have cost push stagflation. Think of supply chain disruptions. Think about what happened in, the food industry because of COVID-19 this year. These are things that have been going much higher in price. Soybeans, corn, wheat, oats, all those are at multi-year highs. Most people, wouldn't know that.
No.
I see these as trends that continue. I believe we're entering into a period, this is just my opinion, where we're going to have a long-term bull market in commodities. And, we did a couple of recent seminars, and if anyone would like to see the slideshow, I'll throw that out to our viewers. We can email it to you. But we had a slide in there that talked about the projection from some of these mutual fund houses of what stocks are going to do for the next 10 years. And I'd say the projections average something like 4 or 5%, right, Bill?
Well,
So,
I just happen to have it in front of me,
oh, okay, good for you.
and now this was a compilation that we looked at of forecasts from four major asset firms, and this was based off of data from September. But what we see is, I mean, their projections, for the U.S. stock market ranged, and these are longer term projections, 7 to 15 years. Their projections are ranging from 5% on the upper bound to a negative 3.6 on the lower bound. Okay, now historically, the U.S. stock market has done about 10% per year on average. So these are significantly lower. And the other thing is, these are nominal forecasts. So these don't take into account inflation. So when we subtract inflation from these expected returns, the results are even worse than what it's showing here. So it does emphasize to us that we need to have multiple streams of return in a client portfolio. We can't just rely on traditional asset classes like stocks and bonds, because with everything priced so high right now, both stocks and bonds, I would expect that if we see a shock like a rise in interest rates, for example, that we'll see the correlation between stocks and bonds tighten, and both could go down, and your bonds in that environment would not give you the downside protection that they would have in the past. So you need some other things.
Absolutely.
But going back to what you were saying about a long-term bull market in commodities, these market cycles in commodities is similar to what we've seen in interest rates, in that they're both very long duration. And we have been on this 50-year decline in interest rates. Similarly, we've been on a multi-decade decline in commodities, and wouldn't surprise me at all if in the near future we start to begin this long multi-decade bull market in commodities once again. It's really about time.
Yeah, inflation. That's another thing I see. I saw a headline go across today that the national minimum wage is likely going to be increased to $15. So the biggest component of inflation comes from increases in unit labor costs. Mm-hmm. And that's what happens. I'm not a fan of high minimum wage mandates, because what happens is small business owners, if they're not paying that right now, they'll get rid of some of their employees.
They'll further automate. You won't see human beings behind the counter at fast food restaurants. You'll just see assembly lines, robots, what have you.
Yeah, so I agree wholeheartedly with William. We've been taking this opportunity to rebalance portfolios. For example, if we started with a conservative client that's 50% stocks and 50% bonds, we're trimming that back with the strength that we had from the stock market. And we're not necessarily just going into bonds. We're including some alternative credit type instruments, or we own quite a few fixed income vehicles that have adjustable rate coupons. So if interest rates go up, our clients benefit from higher income returns. And then along with hedge fund strategies that take advantage of inflation in the commodities markets or deflation. They can go either way. So that's what we're doing at year end. And this rotation from this bifurcated market that you mentioned that we had last year, going from that which ran up what we think maybe excessively, and into those things that maybe haven't moved yet. Value stocks, small cap stocks, lower PE stocks, um, a move away from high quality treasuries, um, shortening duration in our fixed income, and looking for many different engines of return.
Yes. I mean, we've talked about in the past how we see similarities between now and the late 90s prior to the tech bubble bursting. And, we know that no two markets are identical. But, one common thing that we're seeing is, I'll just call it the way I see it, irrational exuberance.
Yeah.
And that's dangerous in markets, because when you get into that environment, people don't pay attention to risk. They're only looking at the return side of the equation, but not the downside risk side of the equation. And in that kind of environment, everyone is an expert. It's too easy to make money. Think Tesla, Bitcoin, and there's no end in sight. Everyone is expecting that trajectory to continue. But the challenge with that, for those who are trying to time when that will turn and end, is that it may not be any one particular thing, that causes the market, to reverse and start moving down. It could be something totally unexpected. All it takes is a catalyst, and we may not have any clue what that catalyst may be. But once people start waking up, to the high valuations and the risk and the frothiness, it can beget more selling, and more selling begets more selling, and then by that time it's too late.
Yeah, I agree. So we have this tug of war going on right now.
We really do.
And that is, a major theme is just this ramp up of problems. The expanding of this virus. I mean, we had the greatest number of deaths, I think, yesterday that we've had since March. When this thing first started showing up in the United States. But we've also, I read in today's Wall Street Journal that through this past Wednesday, we've got about 3% of Americans have been vaccinated. I think most or all of them are going to need a second dose. Some people have begun to get their second doses. So about 10.5 million, or 3% of Americans. Some other countries are doing better. Israel, for example, a country of 9 million people, they've got 1/4 of the population has already been vaccinated. I think they're mandating it for all people over there, but they'll be done probably within, a month to 6 weeks. So that's the thing. What we're seeing is we've got state and local governments some of them wanting to keep things shut down, others, in contrast, wanting to open things up. But we've got the pandemic numbers, worsening. So we do think that this thing's, going to come to an end sometime, maybe late spring, something like that. And we're going to get to herd immunity through the combination of vaccinations and people just catching the virus and it running its course. So what else, William? Do we have anything else to share?
Well, I'll just end with this final thought. There is a benefit to age, and that's called wisdom, and hopefully you have it as you get older. But experiential wisdom is specifically what I'm referring to. And there are a lot of young professionals in this industry who have not experienced, big market sell-offs. We're not around, for the tech bubble. May have been around, may not have been around during the credit crisis of 2008. But unless and until you have experienced these types of events, it kind of leaves you a little ill-prepared. When you have frothy markets like what we have now. So, certainly history can be your guide, and we want to try to educate everyone, not just about opportunities, but also about risks. And we encourage you to check out our outlook on the website at eaglefms.com. If you're watching, obviously you're on our Facebook page, and we try to make timely posts of things that we believe are of interest and should be considered. And we welcome any and all comments. We just want to be helpful to you, our audience.
And on a lighter note, we've got the NFL playoffs down to the final 8. This weekend, the Saints are hosting the Tampa Bay Buccaneers. This game makes history,
Yep.
Bill, because we've got 42-year-old Drew Brees against 43-year-old Tom Brady.
It's a battle of
So
goats.
that almost makes me feel like I could get out there, and watching these old guys. Combined age of these two quarterbacks is 85. So Saints are favored by 3 points. This is going to be a really good game, and I just wanted to say, go Saints! Who dat?
Go Saints! All right. Well, have a great week. And for those of you who are off on Monday, enjoy your extra day off. We will be back next Friday.